When most of us imagine an economic threat, we picture a sudden, dramatic stock market crash. But right now, the actual danger to the American economy is a quiet chain reaction unfolding entirely out of sight. This chart tracks the yield on the 30-year U.S. Treasury bond. On August 18, 2026, it climbed past 5.3%, hitting its highest level since 2007. For years, global investors treated U.S. government debt as the ultimate safe haven. It was a place to park cash where stability was practically guaranteed. That guaranteed safety is exactly why the U.S. government effectively sets the baseline cost of money for everyone else. What the Treasury pays to borrow dictates what the rest of the economy pays. So when investors suddenly demand much higher returns to lend money to the safest borrower in the world, the entire financial system recalculates. Eventually, that math lands right in your monthly budget.
To understand why the bond market is shaking, we have to look at why lenders are demanding a heavier premium. Three distinct pressures are driving these yields up at the exact same time. The first is stubborn inflation. The Federal Reserve wants consumer prices growing at an annual rate of 2%. But current estimates, like the Cleveland Fed's August nowcast, show inflation stuck above 3.3%. The second pressure is supply. The government is running large deficits, meaning the Treasury has to issue enormous amounts of new debt. When you flood the market with bonds, you usually have to offer higher yields to convince investors to buy them all. The third force comes from overseas. Renewed tensions involving Iran have pushed energy price concerns back into the market. If energy costs rise, inflation becomes significantly harder to squash. Higher inflation stacked on top of rising borrowing costs creates an incredibly difficult environment for growth. The central bank is trapped. Every available move carries severe risks for the wider economy. We can already see the damage hitting Wall Street, particularly in the high-growth technology sector. This graphic shows how tech valuations are calculated. These companies are priced based on massive earnings they expect to make years down the road. But when present-day interest rates rise, the mathematical value of those future dollars shrinks today. On top of that, tech giants are borrowing heavily to build expensive artificial intelligence infrastructure. They are taking huge loans at these exact inflated rates. And those high rates do not stay confined to corporate boardrooms. They trickle directly down to everyday consumers. This flowchart illustrates the cascade. A 5.3% Treasury yield forces other lenders to demand higher returns too. That translates into higher mortgage rates, more expensive auto financing, and steeper costs for small business credit. Money itself is now undeniably expensive, and expensive money applies the brakes to every moving part of the American economy. A 5% Treasury yield does not mean we are automatically plunging into a sudden 2008-style financial crisis. In fact, if you hold fixed income assets or have money in a savings account, you are finally seeing a real return on your cash. The systemic danger lies in a slow, relentless squeeze on the entity writing the checks, the federal government itself. If the Treasury must keep rolling over debt at new high rates, interest payments will consume a rapidly growing share of the federal budget. Paying off this past debt at premium prices leaves virtually no room to fund anything else. The central question is no longer whether the Federal Reserve will tweak interest rates by 0.25%. The question is whether the United States can operate under this new reality of permanently expensive money. The quietest market on Wall Street is suddenly ringing the loudest alarm.